Key takeaways from the Fed's third rate cut. The Federal Reserve on Wednesday cut interest rates by a quarter point, the third rate cut since it began to lower borrowing costs in September. The central bank's latest move leaves its benchmark lending rate at a range of 4.25% to 4.5%, a two-year low. The decision to cut was not unanimous, as an attempt to ease pressure on America's economy from elevated interest rates to preserve the labor market's health. Fed Chair Jerome Powell said the latest rate cut was a closer call, adding that recent inflation readings were the single biggest factor on officials' minds during the meeting. Cleveland Fed President Beth Hammack was the lone dissenter on Wednesday's decision, preferring to keep rates at their current levels. The Fed signaled in its policy statement that it is leaning toward holding rates steady in the future, since inflation remains stubbornly above the central bank's 2% target. The U.S. economy has also proved remarkably resilient in the face of elevated borrowing costs, giving the Fed some reassurance that it can stand pat without risking any undue economic damage. The projections overall suggest Fed officials expect the U.S. economy next year to be buoyant, with no recession in sight. They expect inflation to reach their target over a longer period than they previously estimated, not touching 2% until 2027.